So the way we calculate risk and return is not difficult. So when you see statistics, please don't get nervous about math. It's not that difficult. As a reminder, let me show you this graph, and then we're going to go into problems. So here, expected return will be the middle of this bell-shaped curve, right? This is going to be your expected return. We have a normal distribution. And remember, we say risk is all about the probability variance of the outcomes. So what we're going to do is, for each return, we're going to calculate how far we are away from the expected return. And then we're going to take the square of this distance. And then we're going to add them up. Why we're taking the squares? Because this distance and distance is equal. If we add them up, they will just cancel each other out. So things will look less risky compared to what they actually are. So we're going to take the squares to get the distance away from the expected return. So basically, this is what we're going to do. For expected return, it is the average of returns, actually. Okay, it's the average of returns. And for that one, what we do is we are multiplying all the probabilities with the returns in hand. So let's say for two returns with two probabilities, it's going to be P1 times R1 plus P2 times R2. For the variance, for the risk, actually we're going to look at the standard deviation, which is the square root of variance. Okay? And it will be how far we are away from the expected return. We're going to take the square of it. We're going to multiply it with the probability of having the return 1, plus we're going to look at how far we are from the expected return for the second return. We're going to take the square of it, and then we're going to multiply it with the probability of having the second return. So this is going to be our risk and return calculation. Let's look at it with an example. So suppose that you have $100, and we're going to flip 2 coins. For each head, you're going to win 20%. For each tail, you're going to lose 10%. So what are the possible scenarios? You can have head and head. You can have head and tail. You can have tail and head. Or you can have tail and tail. So for each head, your return is increased by 20%. So in the case where you have head and head, you're going to win 40%. Does it make sense to you? Bunu anladık mı? For each head, you're making 20%. So total 40%. For head and tail, for the head, you make 20%. For the tail, you're losing 10%. So your return is 10%. For tail and head, it's the same thing. You're losing 10% for the tail. You're making 20% for the head. Together, it's 10%. For the tail and tail, you're losing 10% for each tail, so you're losing 20%. What is the possibility of having a head and head? What's the probability of this scenario? 25%. What is the possibility of this scenario? They're all 25%, right? So let's write it actually here. So you have 4 scenarios, right? Head, 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 tail, tail, head, tail, tail. They're all 25%. They all have 25% probability. And for this one, your return is 40%. For this one, it is 10%. For this one, it's 10%. For this one, it is minus 20%. So the first thing to do is to calculate expected return. How do we calculate expected return? For each return, you're going to multiply the return with the probability. So for each one, you're going to have 25% times 40%. Bunu 1 bölü 4 olarak da yazabilirsiniz. You can write it as 1 over 4, whatever you want. Okay, doesn't make any difference. Plus 25% times 10% plus 25% times 10% times 25% plus times minus 20%. Or the easy way would be what? Since expected return is the average, and since your probabilities are the same, you can simply do what? Toplayıp 4'e de bölebiliriz. Right? So you can take this in 25% parentheses. Değil mi? It's the same thing. So you have 40% plus 10% plus 10% minus 20%, which is equivalent to, add them up, divide them by 4. It's the same thing. So if you do this, what is the expected return? 10%. So now I'm done with the expected return part. Burada bir sorumuz var mı? Any questions here? Expected return. If the possibilities are the same, you just take the average of the returns. Now in the second part, you need to calculate the standard deviation, which is the square root. Which is the square root of the variance. So standard deviation will be square root of the variance, which is equal to what? My expected return is 10%. Let's write it here. So now, for each case, I'm going to look at how far I am from this 10%. And I'm going to square this distance. Multiply with the probabilities, add them up, then they take the square root. That's it. So for this one, 40% minus 10% is how far I am from the expected return. Değil mi? Şunu yapıyorum. 40% minus 10%. I'm taking the square of it and I'm multiplying it 25%. Soru var mı? Let me do the same thing. It's going to be 10% minus 10%. Take the square, multiply it with 25% probability. I'm going to do it one more time. I have one more 10%, tail and head part. So it's going to be 10% minus 10% to the square of it, multiplied with the probability. And the last one is minus 20% minus 10%. Take the square of it, multiply with 25%. And you're adding everything up. It will give you the variance. Then you're going to take the square root of it, which will give you the standard deviation. Actually, we have it here, so you don't have to write it down. The variance, okay, is 450, so standard deviation is 21.2%. So similarly, since the probabilities are the same, you can also write this in a common parentheses. %25'i dışarı alıp hepsini square halleri toplayabilirdiniz. Aynı şey değil mi? Any questions here? Any questions? You could also write it as this. So you can write it in one common parentheses. Right? You can also write it like that. Değil mi? Okay. Any questions? Okay. So this is how you calculate the risk and return when you have different probabilities, assigned probabilities. You can also calculate returns and standard deviation using historical data, which is what lots of people do in real world as well. So suppose that you have these returns for a stock from 2002 to 2007. Rate of returns are different for each year. How many years do we have? 6. For 6 years, we have 6 years of return. And based on this information, I'm asked to calculate the return, expected return based on historical data, and the risk for this stock. So how do I calculate the return, expected return? Huh? How do you calculate the expected return? Söylesenize. Huh. You're gonna, do we have probabilities here? Probability of observing each year is the same, right? 2002, 2003, they're all the same probability. So simply we can just take the averages, right? So for the rate of return, we have minus 20.9. For 2002, you have 31.6. You have 12.5. You have 6.4. You have 15.8. And you have 5.6. Since it's average, you're going to divide it by 6. So average return will be equal to 8.5%. Once you know the expected returns, then you're going to calculate the deviations from the returns for each year. How far I am from the expected return. So for 2002, for instance, your rate of return was equal to minus 20.9. Your expected return is 8.5%. So the deviation from the expected return will be equal to what? Minus 20.9% minus 8.5%, which will be equal to minus 29.4. O sayının nereden geldiğini anladık mı? So for each year, we're going to look at how the deviation from the mean, this is the deviation from the mean, how far I am from the expected return, or the mean or the average, the same thing. This is mean or average, they're all the same thing. Then what do I need? I need the square of the deviations. So for each year, I'm calculating the squared of the deviation. So these are the deviations. These are the square of them. Then what am I going to do? Arada sorunuz varsa, kaybolduğunuz bir yer varsa sorun. Yavaş gitmeye çalışıyorum. Zor değil zaten ama karışırsa söyleyin. Burada bir sorun oldu mu? Baştan başlayalım. Return'de bir sorunumuz oldu mu? Return hesapladığımızda. Ha? Add them up, divide them by 6 dedik. Burada bir sorun yok. Burada bir şey oldu mu? Her sene için how far my return is from the return, expected return. Burada bir şey oldu mu? Then we took the squares of those deviations. Burada da bir şey olmadı. Then what do I need to do is this basically. So I calculated deviations. I took the squares. Since the probabilities are the same, 1 over 6, I can basically add all the squared deviations and then divide them by 6. Değil mi? Her yılın olma olasılığı 1 üzeri 6 ya. Şöyle. So for the variance, this is going to be R minus, okay, so this is for 2002. This is probability of 2002 plus probability of 2003, R 2003 minus expected return 2003. It will go till 2006, return of 2006 minus expected return square. Böyle yazıyoruz ya. Burada bir şey var mı? Tamam. Probability of having each year is the same. Değil mi? We have 6 years, so you can just remove those parts. And you can add those squared deviations. And then you can basically divide it by 6, since we have 6 years. Add them up, divide them by 6. That's it. Burada soru var mı? So this is going to give you the variance, which is 246. For the standard deviation, you have to take the square root. So if you take the square root, the standard deviation will be 15.7%. So for those 6 years, this stocks had an average return of 8.5% and risk of 15.7%. Sorun, please. Şey var mı? Soru var mı? Okay. If you don't have any questions, var mı soru mu? Vallahi anladım. Okay. Doğru söyle. So if you look at the standard deviations of treasury bills, treasury bonds, and common stocks, this is what we have. So as expected, treasury bills standard deviation was 2.8%. Standard deviation of treasury bonds was 8.6%, and for the common stocks it was 20%. So the higher the standard deviation is, the more risky, the riskier the investment is, as expected. Okay. So these are analyzed standard deviations of weekly, there's a typo there, of weekly returns in the Dow. So this is how Dow index standard deviation is. And it's changed from 8% or so to 55-60% or so. As expected in crisis times, we will have more volatility in the market. So we will see more risk, more standard deviation in the market. So now let's slowly go into diversification. So if you remember, when we talk about mutual funds or hedge funds, we said they do the diversification for you. So as investors, we can pick 5-6 stocks and we can put it in our portfolios. But if you give money to a mutual fund manager, he can pick 50 stocks for you in no time. And diversification should actually reduce the riskiness of your portfolio. So these are different papers with different standard deviations. We have the S&P 500 market index as well. And having one stock is definitely way riskier than having 2-3 stocks in your portfolio. And in this example, hopefully we're going to see this. So suppose that we're considering to buy 2 stocks. One is automobile stock, the other one is the gold stock. Şimdi de böyle çok aslında konuşulan iki şey ikisi de. Altına ne oldu? Otomobil ne oldu? Petrol fiyatları düşüyor. Okay. And suppose that we are expecting 3 outcomes in the economy for the next year. We may observe a recession, we may observe a normal time, or we may observe a boom time. And suppose that we are expecting to see those conditions with equal probabilities. So 1/3 of the chance you're going to have a recession, 1/3 of chance we're going to have normal times, 1/3 we're going to see boom. And automobile stocks returns, since automobile stocks is cyclical, the better the times, the higher the returns. So in the recession, this automobile stock will take away 8% from you. In normal times, you're going to make 5%. In boom times, you're going to make 18%. Or you can consider the gold stock. So da şurayı silelim. You can have the gold stock. Gold stocks move counter-cyclical. So when you're in good times, you may lose money on gold. When you're in the bad times, you make money on gold. So they're moving in opposite directions. And let me write down what we have as well. So you have 1/3 of chance of everything. You can have recession, normal times, or boom. For automobile, it is 8%, 5%. What was the last one? You're losing. You were. Okay, this was bad. This is recession. This is gold. Onu da bana bir okusanıza. Burada mı 20? Her taraftan farklı bir şey çıkıyor. Bu 3, biri 3 dedi. Pardon. Okay. So this is what we have. Okay. So now let's calculate the expected return and risk for those stocks individually. And then we're going to form a portfolio. I'm going to calculate the return and risk just for automobile stock. I don't want to do the same thing for gold. The calculation is the same. The numbers will change. I don't want to lose time on it. So how do we calculate expected return? You tell me for automobile. Very easily, very simple. You can add them up and divide them by 3, since probabilities are same. Or you can do it in the long way, multiply each return with the probability, add them up. So let's do it the short way. So it's going to be minus 8% plus 5% plus 18% over 3. So it's going to be what? 5%. So this is the average return for gold, as for automobile. For the risk, for variance, what am I going to do? I have minus 8%, minus 5%, which is the expected return. Take the square of it, plus, I'm going to do the same thing, 5% minus 5%, take the square of it again, plus 18% minus 5%, take the square of it, okay. And then multiply all of them by 1 over 3, which is the probability. This is for the variance. For the standard deviation, it's going to be 10.6%. So you're going to take the square root of it, which is the square root of the variance. Burada bir soru var mı? So if you're considering automobile stock, its return will be 5%, its standard deviation will be 10% of automobile. If you do the same thing for gold, gold's expected return will be 1%, that was easy, and the standard deviation of gold will be equal to 16.4%. So as you can see, if you have something like this, which one would you prefer, automobile or gold? You're gonna buy one stock. Would you go with automobile? Would you go with gold? Okay. Automobile stocks returns 5. Its risk is 10%, 11%. Gold, on the other hand, its return is lower. It is 1%, and its risk is higher, 16%. Does it make sense to get gold at all? No. So you would go with automobile. But if you're forming a portfolio, having gold stock might be a good thing for your portfolio's risk level and return level. And now we're going to calculate portfolio returns and portfolio risks. Okay? So we're going one step further. Okay. So when you're asked to calculate the return of a portfolio, what you're going to do is this is actually, again, very straightforward. So what you're going to do is, for expected return of a portfolio, you're going to multiply the fraction or the weight of each stock in your portfolio and multiply it with their return. So if you have 2 stocks, you're going to multiply how much money you have in the first stock and how much return that stock will bring to you. And then you're going to add how much money you put in the second stock how much return the second stock will bring to you. So this is going to be the portfolio expected return. So in our question, suppose that automobiles has a weight of 75. Okay, so this is automobile and this is gold, let's say. So you have a pie like this, you have this much money. Let's say you have $1,000, okay? And you want to put 750 on automobile. And you want to put 250 on the gold. So the weight of automobile stock in your portfolio is 0.75. Weight of the gold stock is 0.25, right? How much you distribute your money? Of course, the weight total should be equal to 1. Burada bir sorun oldu mu? Weight nedir? Okay. Now, so weight of automobile is 0.75. Expected return of automobile is 5%. Weight of gold is 0.25. Expected return on the gold is 1%. So the portfolio return will be equal to 4%. You can solve it this way, or you can, this was the short way, or you can solve it in the long way. What is long way? In the long way, you're going to calculate the returns individually for automobile and gold stocks. You're going to calculate, You're going to calculate the portfolio returns for recession, for normal time, and for boom with the weights. So in the recession time, you can lose 8% from automobile, and you're going to win 20% from gold. If you multiply each weight with the returns, you're going to get the portfolio returns in each times. The idea is exactly same what we did. Bir daha geliyorum. Şurada ben bunu hızlıca yapmamın sebebi zaten expected return'leri hesaplamıştık. Ama diyelim ki biz expected return'leri daha hesaplatmadık size sınavda. Ve direkt tablodan da yapabilirdiniz. Yani önce expected return'leri hesaplamadan da yapabilirdiniz. O zaman da şöyle yapacaktınız. Yazalım tekrar. Recession ve boom, normal and boom. And you have -8 for automobile, 20 for gold. For normal times, 5% for automobile. 3% for gold, 18% automobile, -20 for gold. So since you have all these, what you do, you know that you have 0.75 automobile stock in your portfolio in every time, and you know that you have 25% weight on the gold. The only thing you need to do is for each time you're going to calculate the return on your portfolio. So you're going to have -1%, 4.5%, and 8.5% for the portfolio. Burası karıştı mı? Ne yaptığımız anlaşılıyor mu? Is this part clear? So for each economic times, I calculated the return of my portfolio. And for my portfolio, I know I have 75% of my money in the automobile, 25% of my money on the gold. So for each time, for each expected economic condition, I calculated the return of my portfolio. That's it. Then, if you're asked to calculate the expected return, you can add them up and divide it by 3, and you will be done. Tabloya yeni bir satır ekledik ve daha önce otomobil ve altında return'ünü getirisini nasıl hesapladıysak yeni eklediğimiz column'a göre onu tekrar yapabiliriz. Bu da uzun yol olacak. Any questions here? Okay, so for the portfolio return, you can do just what we did above. It's going to be minus 1% plus 4.5% plus 8.5% divided by 3, which will also give you 4% return. So this is going to be the portfolio return. So once you calculate the portfolio returns for each economic times, then remember what we do, we need to calculate standard deviation. So for that, we're going to calculate deviations from the mean, minus 1, minus 4%, 4.5% minus 4%, 8.5% minus 4%, which will give you the deviations from the mean. Then we're taking the square of it. So once you have the squared deviations, just like we did here, once you have the squared deviations, you can add them up, divide them by 3, which will give you the standard deviation when you take the square root of it. So the standard deviation will be around 4%. Okay? So if you calculate the previous case with what we have now, previously you were on lost. Previously you had 2 stocks. You calculated the return of the automobile stock, which was 5%. Its risk level was 11. For gold, return was way lower, risk was way higher. Then we said, pick automobile, it's better. But then I said, what about diversification? Maybe having some gold in your portfolio will hedge your portfolio, will reduce your risk. Then we said, okay, let's put 250 on the gold stock. It's 25% of my money on gold stock. Then now I have a portfolio, not individual stocks. And from this portfolio, my expected return is 4%, almost as good as automobile stock, way better than gold stock. But look at the risk. You reduce the riskiness of your portfolio from 11% to 4%. So this is diversification. So having some kind of adding more stocks in your portfolio will create diversification for you, and it can decrease the riskiness of your portfolio, which is a good thing. Almost same return with less risk, so you can obtain it. So when you're adding stocks to your portfolio, which one makes more sense, you think? So if you have 2 stocks which move together, so when one wins, the other one wins. When one loses, the other one loses. Would you add a positively correlated stock whose stock's return is positively correlated with what you already have in your portfolio? Or would you add a negatively correlated return stock, like stock C, which will move in the opposite direction with your stock? Which one makes more sense for diversification? You would definitely, when you're adding stocks in your portfolio for hedging to reduce risk, you should go with stocks which will move in the opposite direction with the stock you have in hand. Just like here, if you remember here, when in the recession, automobile stock makes you lose money, but you make money on gold. So they move just in opposite directions, which helped you a lot for diversification. So you reduce your risk. So when adding stocks in your portfolio, go with negatively correlated returns as much as possible. Okay. So in the real last couple of things before I conclude. Perfect. We're gonna finish the chapter. So in real world, if you look at how Ford stock moves with network mining stock, which is automobile and gold, from 2004-2007, this is the network mining one, the green one. This is the Ford one, the blue one. As you can see, they move almost always in opposite directions with each other. Not all the time, but in many times. So if you create a portfolio using automobile, Ford stock and network mining stock, as you can see, you have a portfolio with smoother returns. Smoother returns means more risk. Your expected return is lower than network mining, way higher than the Ford return, but acceptable rate of return with way risk basically. So this is what you do for diversification, adding stocks to your portfolio. So basically, when we are looking at individual stocks, this is important because we are moving into capital asset pricing model a little bit. When you're picking individual stocks, standard deviations are important for you. Standard deviation of returns is important. But when you have a portfolio, then how each stock will affect the riskiness of your portfolio will be important for you. So it's not, now you don't care that much about the individual standard deviation of the stocks, but you care more about how that stock will affect the riskiness of your overall portfolio. And the more assets you have in your portfolio, the less risk you will have. So this is the number of securities in your portfolio. This is the portfolio standard deviation. As you can see, as you add more and more stocks, you reduce the riskiness of your portfolio up to some level. And actually, this will give us a difference between two risks. One is unique risk and the other one is market risk. So what is unique risk? It's basically the risk that affects only one firm. Unique risk, it is also called diversifiable risk or unsystematic risk. It's the risk that is relevant for one firm. Market risk, on the other hand, is the economy-wide risk that affects the overall stock market, and it is called systematic risk. So going back, as you can see, by adding more stocks, you can reduce the unique risk in your portfolio. You're getting rid of the risk that will affect only one stock, but you're stuck with one kind of risk, which is systematic risk, which is the market risk. So in capital asset pricing model, we will not try to risk unique risk because you can get rid of it by adding more stocks in your portfolio, but we will try to price the systematic risk, the market risk. And how each stock will react to the market risk will be important for us. So the last thing about risk is, one thing is some risks look big but dangerous, but they're really diversifiable. Like think about insurance companies. Insurance companies are taking huge risk, right? They take all the, fire, theft, and all kinds of risks. But overall, their portfolio is not risky because they were diversifying. They are dealing with probabilities and stuff. They are getting rid of the individual risks, basically. The other one is market risks are macro risks. Like some companies are very open to market risk, like airline companies. If you're in recession, people don't do leisure traveling, like fun traveling. So they're affected more. Food companies, we all need food all the time. Walmart's return doesn't change that much, even in recession, because people need food. The last one is risk can be measured. We learned how to measure risk by standard deviation for individual stocks. For portfolios, we're going to use something else, which we will call beta, and we're going to do it after the exam. We're going to talk about it next week, basically. Do you have any questions? Then we're done for today.